Hey everyone, and welcome back to Safe Simple Sound Tax Edition. I'm your host Sam, and I'm thrilled you're joining us today as we tackle a topic that's crucial for anyone who wants to seize financial control and embrace mastery of cash flow, two core tenets of our secured philosophy here at Safe Simple Sound. Today's episode is all about estimated tax, which draws heavily from IRS Publication 17. So get ready to take notes, because we're about to simplify the seemingly complex world of estimated tax. Let's dive in. Let's start the episode with an important aspect of managing your finances, especially if you're not a traditional W-2 employee: estimated tax. This might sound intimidating, but trust me, once you understand the basics, it's totally manageable. So what is estimated tax? In a nutshell, it's the way the U.S. government ensures everyone pays their taxes throughout the year, not just in April. Think of it like this. If you're an employee, your employer withholds taxes from each paycheck. It's automatic. But if you're self-employed, a freelancer, a small business owner, or even if you have significant investment income, you're responsible for making those tax payments yourself. That's what estimated tax is all about. It's a pay-as-you-go system for income that isn't subject to withholding. Now, who needs to worry about this? The general rule is, if you expect to owe at least $1,000 in taxes after subtracting your withholdings and any refundable credits, you likely need to pay estimated tax. You'll use Form 1040-ES to figure this out. It's like a mini tax return you do each quarter. Let's break down the key points here. First, the pay-as-you-go part. Imagine you're a freelance graphic designer. You get paid per project, and no taxes are taken out up front. That means you need to set aside money for taxes throughout the year and send it to the IRS quarterly. It's like putting money into a tax piggy bank regularly, instead of scrambling to find a huge sum in April. Second, the $1,000 threshold. This is where you need to do some estimation. Think about your income, your deductions, and any credits you might be eligible for. If, after doing the math, it looks like you'll owe more than $1,000, estimated taxes are on your radar. Third, the payment amounts. There is the general rule to follow. You need to pay the smaller of two amounts, either 90% of the tax you expect to owe for the current year or 100% of the tax you paid last year. So if your income is relatively stable, looking at last year's tax return is a good starting point. However, and this is important, if you're a higher earner, meaning your adjusted gross income AGI was over $150,000 or $75,000 if you're married filing separately, that 100% goes up to 110%. This is one of those estimated tax rules you need to be aware of. Now, it's not just freelancers and business owners who need to think about this. Let's say you have a side hustle selling handmade crafts online, or you receive substantial income from investments like dividends or capital gains. Or maybe you're retired and drawing from a 401k or IRA, but you haven't opted for enough withholding. Even winning a large sum of money in a lottery or contest can trigger estimated tax obligations. These are situations many people don't always think about. Another area is rental income. You generally have to pay estimated taxes on that. These are all scenarios where income isn't subject to automatic withholding, so estimated tax payments become your responsibility. There are also specific estimated tax rules for farmers and fishers. If at least 2/3 of your gross income comes from farming or fishing, you only need to pay 66 2/3% of your current year's tax, instead of the usual 90%. This is a special provision to account for the fluctuating income in those industries. And finally, there are exceptions. You don't need to pay estimated tax if you meet all three of these conditions to not pay estimated tax. You had no tax liability last year, you were a U.S. citizen or resident alien for the entire year, and your tax year was a full 12 months. Essentially, if you didn't owe any taxes last year, you're likely off the hook for estimated taxes this year, provided your situation hasn't changed dramatically. So, how can you proactively see if your withholding is enough? Regularly check your pay stubs and compare your year-to-date withholding with your estimated tax liability for the year. If you see a big gap, you can adjust your W-4 form with your employer to increase your withholding. This can often eliminate the need to make separate estimated tax payments altogether. To recap, Estimated tax is a pay-as-you-go system for income not subject to withholding. You likely need to pay it if you expect to owe at least $1,000 after withholdings and credits. Remember the 90-cent, 100-cent, 110% rule, and be aware of the special rules for certain professions and high-income earners. And don't forget the exceptions. Here's your call to action. Review your 2024 tax return and try to estimate your 2025 income. This will give you a good indication of whether you might need to pay estimated taxes. Grab Form 1040-ES from the IRS website. It has worksheets and instructions to guide you through the calculation. Don't wait until next April to find out you owe a big chunk of change. All right, folks, we've just covered who needs to pay estimated taxes. Now, let's dive into the practical side, how to actually calculate and pay them. This might sound intimidating, but trust me, we'll break it down into manageable steps. Think of it like planning a road trip. You need to know your destination, your tax liability, your route, the calculation, and your fuel stops, the payment deadlines. So, let's get started. First up is how to calculate estimated tax. The best tool for this is Form 1040-ES, which you can find on the IRS website. It's essentially a mini tax return that you fill out quarterly. Use your previous year's return as a roadmap. Look at your adjusted gross income AGI, your taxable income, any deductions you took, and any credits you claimed. This gives you a baseline. Then factor in any changes you expect this year. A new freelance gig, a raise, a side hustle selling those amazing crocheted cat hats you've been working on. Whatever it is, estimate how it will impact your income and adjust accordingly. This leads us to a key question asked by many of our listeners. What are some common mistakes people make when calculating their estimated taxes? One of the most frequent errors is simply underestimating income. It's easy to be optimistic, especially when starting a new venture, but it's crucial to be realistic. Another mistake is forgetting about deductions. Remember, you can deduct certain business expenses like home office costs or supplies, which can significantly lower your taxable income. Next, let's focus on the estimated tax due dates. The IRS divides the tax year into 4 payment periods, and these dates are crucial. Think of them as those fuel stops on your road trip. Miss one, and you might run into trouble. The deadlines are generally April 15th, June 15th, September 15th, and January 15th of the following year. So, for example, your first estimated tax payment for 2025 income is due on April 15th, 2025. Don't get caught off guard. These dates can sneak up on you. I recommend setting reminders on your phone, your calendar, wherever you'll see them. Now, let's tackle how to pay estimated tax. You've got several options, each with its own pros and cons. If you had an overpayment on your previous year's return, you can choose to credit that towards your estimated taxes, basically rolling it over. This is like starting your road trip with a full tank of gas. Another option is a direct bank transfer from your checking or savings account, which is often the simplest and most secure method. You can also pay with a debit or credit card, though be aware that there might be processing fees. The IRS will charge convenience fees for payments by debit or credit cards. Finally, you can go old school and mail in a payment voucher Form 1040-ES with a check or money order. This brings us to another listener's question. What are the advantages and disadvantages of each payment method? Let's take each one. Crediting an overpayment is easy, but it means you won't get that refund money back right away. Direct bank transfer is convenient and usually free, but you need to ensure your bank account information is accurate. Debit credit cards offer flexibility, but those processing fees can add up. And mailing a check is reliable, but it takes time to process, and there's always a slight risk of it getting lost in the mail. Ultimately, the best method depends on your personal preference and financial situation. Throughout the year, it's critical to maintain good records. This is all about tracking your income and expenses. Think of it like keeping a detailed logbook of your road trip. Every mile driven, every gallon of gas purchased. Keep receipts, invoices, bank statements, anything that documents your financial activity. This isn't just good practice, it's essential for accurately calculating your tax liability and avoiding any surprises come tax time. Accurate record keeping is your best friend. It makes calculating your estimated taxes so much easier and it's invaluable if you ever get audited. Finally, don't be afraid to ask for help. Tax law can be complex, and everyone's situation is unique. Consider using tax software, which can automate many of the calculations and help you stay organized. Or, if your income is particularly complicated, say you have multiple income streams, rental properties, or significant investments, it's often worth consulting a tax professional. They can provide personalized guidance and ensure you're meeting all your obligations. Think of them as your expert navigator on this financial journey. So to recap, use Form 1040-ES and your last year's tax return to calculate. Remember those 4 quarterly deadlines, April 15th, June 15th, September 15th, and January 15th. Choose your payment method: credit and overpayment, direct bank transfer, debit credit card, or mail-in voucher. Keep meticulous records, and don't hesitate to seek help if you need it. My call to action for you today is simple. Set those reminders for the quarterly estimated tax due dates right now and choose the payment method that works best for you. Don't procrastinate. Being proactive about your estimated taxes will save you stress and potentially penalties down the road. We've just covered the basics of estimated taxes, who needs to pay them and when. Now let's talk about what happens if you don't pay enough or pay late. We're diving into the sometimes scary world of underpayment penalties, but don't worry, we'll break it down and show you how to avoid them. It is all about being proactive and prepared. Think of it like this. The IRS wants its money throughout the year, not just in April. They operate on a pay-as-you-go system. If you're not having enough taxes withheld from your paycheck, or if you have income that isn't subject to withholding, you need to make those payments yourself, quarterly. If you don't, you might face an estimated tax penalty. So let's get into the details. Our first key point: if you don't pay enough estimated tax by each due date, you may face a penalty, even if you're due a refund at the end of the year. That's right, even if you're owed money, you can still get hit with a penalty for underpaying throughout the year. It's like forgetting to feed a parking meter. Even if you come back early, you might still get a ticket. Next, let's talk about how that penalty is calculated. The underpayment penalty isn't a flat fee. It's calculated based on the amount you underpaid and the number of days it remains unpaid. The longer you wait and the more you owe, the bigger the penalty. It's like compound interest, but working against you instead of for you. Now, how do you figure out if you owe a penalty and how much? Well, the IRS has a form for that, of course. It's Form 2210, and it can help you determine if you owe an underpayment penalty and calculate the amount. It might seem intimidating, but it's essentially a step-by-step guide to walk you through the process. If you're feeling overwhelmed, a tax professional can always help you navigate it. But the best strategy is to avoid the penalty altogether, right? And that brings us to our fourth key point. You can avoid penalties by paying enough on time, adjusting your withholding, or meeting the safe harbor rules. This is where you have some control. Paying enough on time is self-explanatory. Make those quarterly payments. Adjusting your withholding means changing your Form W-4 with your employer so they take out more or less tax from your paycheck. And the safe harbor rules? They're basically guidelines that, if you meet them, guarantee you won't owe a penalty. Generally, this means paying either 90% of the tax you owe for the current year or 100% of the tax you owed for the previous year, 110% if you're a higher earner. Think about your W-4 like the steering wheel of your tax liability. Small adjustments throughout the year can keep you on course and avoid a big swerve and a potential penalty at tax time. Finally, and this is crucial, if you have a significant change in income during the year, recalculate your estimated tax to avoid underpayment. Let's say you get a big bonus, start a side hustle, or sell some stock for a large profit. That extra income means you'll likely owe more in taxes. Don't wait until the end of the year to figure that out. Adjust your estimated tax payments or your W-4 accordingly. Now, a couple of quick clarifying questions. Are there any circumstances where the IRS might waive the underpayment penalty? Yes, there are. Things like casualty, disaster, or other unusual circumstances can qualify you for a waiver. Also, if you retired or became disabled during the tax year, you might be off the hook. The IRS isn't out to get you. They understand that life happens. And how does adjusting your W-4 throughout the year help? Well, if you're receiving a regular salary, your W-4 dictates how much tax is withheld from each paycheck. By updating it, you can fine-tune your tax liability throughout the year. If you're consistently getting large refunds, you're essentially giving the government an interest-free loan. You could be using that money. Adjusting your W-4 can put that money back in your pocket now and potentially eliminate the need for estimated tax payments altogether if your withholding covers your entire tax liability. So, to recap, underpayment penalties are avoidable. Pay attention to your income, make those quarterly estimated tax payments if necessary, and adjust your W-4 as needed. It's all about staying informed and taking proactive steps. Your call to action for this segment is simple. Review IRS Publication 505 for detailed information on penalties and exceptions. It's a treasure trove of information. And if you receive a salary, take a look at your W-4 and consider adjusting it to optimize your withholding. We've covered the basics of estimated taxes, who generally needs to pay them, and the potential pitfalls of underpayment. Now let's dive into some specific situations where estimated taxes become particularly relevant. Think of it like this. We've built the foundation. Now we're looking at the different types of houses that might sit on that foundation. This isn't a one-size-fits-all situation. Your tax obligations can vary dramatically depending on how you earn your income. So let's break down some common scenarios. First up, the self-employed, freelancers, and independent contractors. If you're your own boss, congratulations. But that also means you're responsible for handling your taxes in a different way. You're essentially wearing two hats, employee and employer. This is where self-employment tax comes into play. Unlike a traditional employee who has taxes withheld from their paycheck, you need to pay both income tax and self-employment tax quarterly. Self-employment tax covers your Social Security and Medicare contributions, the things your employer would normally be splitting with you. Think of it like ordering takeout. As an employee, your meal taxes is already paid for when it arrives. As a self-employed individual, you have to cook the meal, calculate your income, set the table, determine your deductions, and pay the bill, remit the taxes yourself 4 times a year. The calculation of self-employment tax is different because it combines both the employer and employee portions of Social Security and Medicare taxes. Regular income tax only considers your earnings, while self-employment tax adds the employer's share, essentially doubling the rate for those contributions. It's crucial for freelancers to understand this because overlooking it can lead to a surprisingly large tax bill, and you guessed it, potential penalties. Next, let's talk about landlords. If you're receiving rental income, that's fantastic. Passive income is a great wealth-building strategy. However, that rental income is generally not subject to withholding. This means you'll likely need to pay estimated tax for landlords. The IRS doesn't get its cut automatically, so you need to proactively send it in. Imagine you're running a bed and breakfast. Guests pay you for their stay, but you don't automatically side a portion for taxes each time. Instead, you need to estimate your annual income, factor in relevant deductions, and make quarterly payments to the IRS. Now, what about those deductions? Landlords, you're in luck. You can typically deduct expenses related to your rental property, like mortgage interest, property taxes, repairs, and depreciation. This reduces your taxable rental income and therefore your estimated tax payments. It's like getting a discount on that tax bill for maintaining your property. Some typical landlord deductions include mortgage interest, property taxes, insurance, repairs, maintenance, depreciation, and even advertising costs. These deductions can significantly lower your taxable rental income and therefore your estimated tax obligation. Keeping detailed records of all these expenses is essential. Moving on, let's consider investors. If you have significant income from dividends, interest, or capital gains, you might also need to make estimated tax payments. This is particularly true for estimated tax for high-income earners. If your investments are doing exceptionally well, congratulations again. But remember, Uncle Sam wants his share throughout the year, not just in April. Think of it like winning a series of smaller prizes throughout the year. You wouldn't wait until the end of the year to celebrate. You'd likely enjoy each win as it comes. Similarly, the IRS expects to receive its share of your winnings on a regular basis. Now, a special note for our farmers and fishers. You folks have slightly different rules. Because your income can fluctuate significantly depending on the season and market conditions, you have some flexibility. Generally, estimated tax rules for farmers and fishers allow them to pay a lower percentage of their estimated tax, often 2/3 of their total tax liability, in 1 or 2 installments, rather than the usual 4. This acknowledges the unique challenges and income patterns of your industries. It's like having a payment plan that's tailored to your specific harvest or fishing season. Finally, let's touch on estimated tax for resident aliens. If you're a resident or non-resident alien in the United States, you may also be required to pay estimated tax, depending on your income source and residency status. The rules can get complex, so it's crucial to understand your specific situation. So, what's the key takeaway here? If your income isn't subject to standard withholding, or if your withholding isn't enough, you probably need to be thinking about estimated taxes. Whether you're a freelancer juggling multiple gigs, a landlord managing properties, a successful investor, a farmer or fisher navigating seasonal income, or a resident alien understanding your tax obligations, it's crucial to be proactive. My call to action is simple. If you fall into any of these categories, self-employed, landlord, high-income investor, farmer, fisher, or resident alien, take the time to research the specific rules and regulations that apply to your situation. The IRS website, irs.gov, is a great resource, and you can also consult with a qualified tax professional. They can help you navigate the complexities and ensure you're meeting your tax obligations without overpaying or incurring penalties. Don't wait until the last minute and get caught off guard. Being informed and proactive is the key to financial peace of mind. And that's a wrap on our deep dive into the world of estimated tax. I hope this episode has shed some light on this often confusing but incredibly important aspect of managing your finances and truly helped you seize financial control. One of the things that really struck me and that I hope resonated with you is the importance of proactive planning. Don't wait until tax season to realize you owe a significant amount. By understanding your income sources and using the tools we discussed like Form 1040-ES, you can estimate your liability throughout the year and avoid those nasty surprises, which is paramount to creating a financial safety net. Until next time, stay informed, stay proactive, and keep making those sound financial decisions. This is Sam, your host, signing off.